how to outperform the market in 2025. I love doing those videos with you guys, as I believe in the market we all go through the same phase, we all have the same story, we all make the same mistakes, we have the same struggles, and we learn from them. And if I can help you guys learn something in those videos for free, instead of you learning from your own mistakes and taking you years and years for you to be comfortable doing something, if I could just help one person, then I would be very, very grateful. And that's why I do those things. They don't get a lot of views. Like the last one I said, don't DCA based on the price, DCA based on the fundamentals. You guys loved it, only got 6,000 views. But I believe this one's gonna be even more insightful, because I'm gonna share 3 reasons why 90 or 95% of investors don't outperform the markets. Those are 3 things that are keeping you away from pretty much killing the stock market, killing the S&P 500. And if someone tells you it's impossible, it is possible if you put in the right effort and if you're willing to listen to what I'm about to say, because I believe those 3 things are dragging you down in terms of potentially unlocking your returns in your portfolio and seeing a major difference in your returns. And I'm gonna talk about them. And again, they don't get a lot of views, so if you do enjoy them, all I'm asking is please press the like button and let me know what you think in the comments. Now, this is the first one, and it's by far the most popular one, and I noticed that from myself. It took me 4 or 5 years before I was comfortable enough to even do that, and this is averaging up. Most retail investors, they cannot average up. If they pay a price, they pay $80 for a stock, the stock goes to 85, and they only have a small position, they can't pay more than they initially paid. They can only average down. When you average down, you lower your cost basis, it makes you feel better. But once the stock goes up, you can't pay more than you did. You can't see your cost basis goes up. It just feels weird. It doesn't feel normal. And this is a very, very hard mental barrier that you have to get over. And once I started averaging up in my portfolio, my returns have never been the same. This is a big one. And this is pretty much a study that shows the difference between buying stocks at 52 weeks lows and buying stocks at 52 week highs. And as you can see in the green, buying stocks at 52 weeks highs has massively underperformed the orange, which was buying stocks at 52 weeks low. And this is something that I really learned the hard way, is that in the market, stocks trade at 52 weeks highs most of the times for the right reasons. So Nvidia is doing well, it's trading at 52 weeks high. The market is rewarding Nvidia for doing something right. And maybe the market is punishing Intel for doing something wrong. That's why Intel is trading at 52 weeks lows, and that's why Costco or Nvidia, they are trading at 52 weeks highs. So once you get over the 52 week high, 52 week low, and you stop having anchoring, price anchoring, Warren Buffett talks about this, that you just can't, you have to forget what you paid for the stock and look at how the fundamentals have changed. So yes, maybe the stock is up 20% since you bought it, but maybe earnings per share went up 25 or 30%, and the multiple is still the same. So you cannot, again, look just at the price. You have to look at the improvement in fundamentals, and then you have to look at the long-term potential of the stock. So if you have a stock, you paid $10, it goes to $11, but you believe the stock could go to $50 in 10 years, is it really worth waiting for that $1 or $2 dip? Maybe it makes sense to average up. I own that stock, Hims and Hers Health. I started buying it at $7. Then I bought the stock at $11. And I bought the stock at $21. I averaged up 200 or 300% above my cost basis because the fundamentals have been getting better. So if you really want to outperform the market, you cannot shy away from averaging up on a stock. In fact, I did much better by averaging up versus averaging down. Whenever I'm averaging down, it's like I'm adding more to a potential mistake. But if I'm averaging up because the company is doing well and the stock is going up, I had much more success than when I was averaging down on losers. They just kept going down, and they were going down for good reasons. And this is, again, a major mental barrier, but it's going to take you some time. Maybe you could start a little bit, maybe you add a few shares, and then you get more comfortable over time. But it took me 4 or 5 years to be comfortable averaging up. And some investors, they never can get over this mental barrier. But once you realize that it's just a barrier, it's just a price, forget about it. Look at the fundamentals, the change in fundamentals, and look at the long-term potential of the company and ask yourself, is it really worth to time this $1 or $2? Stop looking at your cost basis, look at the stock like you're just buying it right now, and it's really going to help you in a major way. So if you want to outperform the market, you have to be able to average up. This is the second one. And this is something that's very hard to do. And most retail investors, they can't really do that stuff. And this is not being fearful when others are greedy, which means being fearful when others are greedy. This is something that Warren Buffett said. He said, be fearful when others are greedy, and be greedy when others are fearful. Now, most retail investors, they love being greedy when others are fearful. They love buying fear. They love buying blood on the street. They love just buying, a lot of sell-off stocks at 52 weeks low when the market's going down. They say, oh, this is a discount. This is a buying opportunity. They love buying the dip, and they love being greedy when everyone is fearful. Retail investors, they love that stuff. But very few retail investors can also be fearful when others are greedy. And whenever I make such videos on YouTube, people tell me, oh, but you're timing the market. No one can time the market. Being fearful or being conservative when others are greedy, when the risk to reward setup isn't there, it just doesn't mean you're timing the market. It means maybe you're just being disciplined. For example, if I look at the S&P right now, we're trading at 21 times forward earnings. The peak in 2021, before the 2022 stock market crash, was at 23 times. Now we're trading at 21. The peak at the dot-com bubble, okay, it was 25 times. And now we're trading at 21 times forward earnings. And those earnings, they are massively inflated. We have massively inflated earnings expectations. If I combine the multiple to the yields, the 10-year right now is trading at 4.5, okay? Now look at that, 4.5% on the 10-year, okay? You look at the 4P, is trading at 21. In 2021, it was also trading at 21. But in 2021, the yield on the 10-year was at 1%, 1.2%. Now the yield is at 4.5%, and we're trading at the same exact multiple. If you look at the 30-year yield, it's trading at 5%. 5%, and we're trading at historical highs on the S&P 500, 21 times forward earnings. I'm seeing 50% tariffs on Europe and potentially 20 or 30 or 40% on China. Even 20% on China isn't too bullish for the markets. We look at the fear and greed index, which many retail investors love. We were at extreme greed. Just a few days ago, it was almost at extreme greed, pretty close, and now we're still in greed territories. There's a lot of greed in the market. There's a lot of people showing off year-to-date returns on X. There's a lot of massive overconfidence, where everyone is so confident that they bought the dip and they did the right thing, and investing is easy. Investing is feeling easy again. Once you see all this greed in the market, you see massively high bond yields, you see a potentially higher inflation, the Fed is not cutting, and you're seeing earnings at 21 times forward earnings, maybe there's more risk than reward over here. And I think you could agree with me that there's more risk than reward. Now, maybe it makes sense in this case to look at your portfolio and say, okay, I like those 10 or 11 stocks so much. Stock number 12, I like it, but it's not in my high conviction ideas. So maybe at this stage, it makes sense to sell the stock and keep a cash position because there's more risk than reward. So I can be fearful when others are greedy. And then now I have the resources to be greedy when everyone else is fearful in a few weeks from now or in a few months from now. That's not called timing the market. Or maybe you might decide to buy a put option and hedge your portfolio in case the market goes down. Your put option is going to go up a lot, which is something that I do. And I actually did that a few days ago when we will reach 6,000. And you can protect your portfolio this way. None of those things I call timing the market. So very few investors can look at the setup of the market and they say, okay, now there's more rewards than risk. A few weeks ago in April 2nd, April 4th, when a lot of people were buying the dip, you could look at the market, you say, okay, the yields are a little bit high, but the ratio was around 18 times and there were so many amazing opportunities. There's more rewards than risk. So I'm going to deploy a lot of capital. But now at this stage, maybe there's more risk than reward. So it makes a little bit more sense to be prepared, to be conservative, to be fearful when others are greedy. This is not called timing the market. So you can't just be greedy when others are fearful. Great investors, if you want to outperform the market, you also have to have the ability to be fearful when others are greedy, even though it doesn't feel great. Like whenever I do a video about a potential crash, I normally do it when the market's going up. And I get a lot of dislikes because people tell me I'm timing the market, no one can time the market, or because I'm telling them that their stocks could go down. And the last thing you want is when you're looking at your gains and you're happy that your portfolio is up up so much. The last thing you want is for me to tell you why stocks could go down. So it's not easy to forget about your gains, forget about your year-to-date return, and be open-minded enough to look at the setup and say, okay, maybe here, I love my stocks. I'm not going to sell my stocks, but maybe the cash that's coming in my portfolio from my job, I'm not going to deploy it. I'm going to keep it on the side because maybe there's more risk than rewards. And once the reward exceeds the risks, the underlying risks, then I'm going to deploy my capital. And this is what Warren Buffett said: be fearful when others are greedy, and be greedy when others are fearful. And if you want to outperform the market, you have to be able to do both of them. And this is very, very important. Now, this is the last point, which by far is going to get me the most, it's the most controversial one. It's going to get me a little bit in trouble, but I'm going to try to explain what I mean by this one. And it says only buying quality. Okay. Now, if you look at the most popular strategy in investing right now, especially amongst on YouTube and among retail investors in general, is buying quality stocks and holding forever. And this is an amazing strategy, and it's by far the easiest strategy in the market. So if you want something that's easy, anyone can identify a quality company and hold it forever. You don't need a rocket science degree, or you don't need to pay anyone to tell you how to pick a quality stock and hold it forever. And if I look at my portfolio, around 60 to 65% of my portfolio is in quality stocks, and I hold them forever, and I don't want to sell them. Okay, and I believe this strategy is amazing, and it's really good for someone that has a full-time job and you don't want to put in a lot of effort and time in the market. This is an amazing strategy to buy the best companies and hold them forever. But many retail investors, and again, I'm judging from the comments, they actually believe that the only strategy that exists in the market is buying quality stocks and holding forever. So they believe the only strategy that works is just buying quality. If you try to trade options or do anything with options, all those things are speculative, because Warren Buffett said buy quality, and Buffett said stay away from options. Buffett said you can't time the market. Buffett said maybe value investing is dead, so they don't look into the value stocks. Turnarounds, they don't work. They're value traps, and they just technical analysis doesn't work. It's speculative. It's all messed up, and they just believe that the only strategy is buying quality and holding forever. Now, it's the easiest strategy, but if you have time in the market and you're willing to potentially do something harder than picking quality stocks, you potentially could lose money. You could have some massive setbacks, blowouts. You could have a lot of things happen, but you could learn a few things. I think you're missing out on a lot, because investing is much more than that. And there's just amazing opportunities and so many strategies that you could incorporate in your portfolio. Now, if I look at Warren Buffett's returns, okay, this is all public. I'm not making this up. In 1965, he made 49.5%. Okay, the S&P did 10%. In 1968, he did 77%. The S&P 500 did 11%. In 1971, Buffett did 80%. The S&P did 14%, okay? In 1976, he did 129%, 23% for the S&P. 1979, he did 102%. The S&P only did 18%. Now, if you look at such returns, do you guys really believe that Buffett got those returns by just buying quality stocks and holding them forever? The truth is, of course not. Because maybe you are a quality investor. Have you ever had a 129% year, 80% year, or 50% year? You could hardly get such returns if you buy the best companies and hold them forever. Now, whenever Buffett started doing quality investing, because his portfolio was so large, he couldn't get in and out, he couldn't do all these things. This is when his returns went down, and he mostly has underperformed the S&P 500. So what I do in my portfolio, I try to copy the young Warren Buffett, not the old Warren Buffett. But I personally believe that Buffett is like the most misquoted person on YouTube and on the internet. And that's, again, it's a different perspective I'm going to give you. I like giving different perspective, and I'm going to break it all down. And again, you can Google everything I'm saying. I'm not making this up. The first one is that Buffett, he said, stay away from options. Options are instruments of mass destruction and all these things. But if we look at what Buffett did himself, okay, in 1993, Buffett wanted to buy shares of KO, which is Coca-Cola stock. But he really wanted the stock for about 10% below the market price. So rather than overpay, he sold put options at the price he wanted to pay and pocketed nearly $7.5 million in income while he waited for a price correction. And this is something that I also do. If you learn how to sell options, you can make 1 to 2% a month. You don't even have to have a dividend stock pay you 5% a year. You can make 1 to 2% per month. But I saw, guys, you guys believe that Buffett, he said stay away from options. Well, he himself is trading options. That's something interesting, right? It's a different perspective. Something else, people said, Buffett said, don't short stocks, stay away from shorting. Shorting is speculative. But if we look at what Buffett did to get those 70 and 100% return years, he said in his early days, Buffett made the use of short selling to hedge his long portfolio. Very interesting, right? He used to go around trying to borrow share certificates from institutions such as college endowments, pay them a small fee, and use these holdings as a way of shorting the market. But I saw Buffett said, stay away from shorting. I'm not telling you guys to go and short the market, but I'm giving you a different perspective than what people give the image of the current Buffett, which he only buys quality. But what really made Warren Buffett is going outside of quality investing and being open-minded to many different strategies in his early days. That's another one. People said, Buffett said, buy and hold forever. If you get out of stocks or if you trim, that means you're timing the market. That's what people say on YouTube. But if you look at what Buffett actually did, it says in a 2010 study of how markets react to Berkshire trades, researchers found that of the 230 different stocks the company owned between 1980 and 2006, it held 60% of them for less than a year. 60% of those stocks, Berkshire held them for less than 1 year, or considerably less than forever. It kept just 9 of them for at least a decade. But I saw Buffett guys said buy and hold forever. This is, again, a very different perspective. So I'm not telling you guys to go short stocks and go get in and out and do all these things. I'm saying quality investing in general is an amazing strategy. But if you have time on your side and you're staying away from everything else because you believe it doesn't work, maybe it's good to try it out and see what else is available. Maybe it's good to try out value investing. Maybe it's good to learn a little bit of options. You could maybe buy let's say you believe the market's overvalued, you could maybe buy a put option for your portfolio. It's a small percentage. This put option goes up in value if your portfolio goes down. So it offsets your losses and it gives you a cash cushion for you to take and buy the dip on your favorite stocks. But if the market keeps going up, then you're still going to make money if the position is small enough. And it's more of having insurance than trying to time the market or shorting the market. So if you're open-minded, you could learn a lot of things. And I do all these things in my portfolio from time to time. That's why I'm up this year around 13%. The S&P is down 1.2%. I didn't do that by just buying quality stocks and holding them forever. Last year, I was up 54%. That's really hard to do by, just buying Apple and buying, the quality stocks. I'm not doing this to brag, but I'm just showing you that I actually do what I'm saying. And there's a strategy outside of just quality investing if you're really open-minded and if you have time on your side. If you don't have time on your side and you want something that's simple, easy, you want to focus on your job, on your career, you just want something that's simple, then the best strategy is buying quality. And I do that with 65% of my portfolio. But I also do turnarounds from time to time. I do value investing sometimes. I also do options from time to time to collect income, 1 to 2% a month. Or sometimes I hedge my portfolio like I did recently, and those puts are up 27%. So if you want to learn all those things about put options and all these things, I share them all in real time in my investment group. If you're interested, this is the link. But that's just what I wanted to say about, outperforming the market and Warren Buffett and all these things. Maybe it was a different perspective, but I'm curious to hear what you have to say in the comments. So if you do enjoy it or if you didn't enjoy it, please give me your feedback. Let me know your opinion. Thank you for watching again. Not financial advice. If you did enjoy it, press the like button. Maybe consider subscribing, and I'll talk to you in another video.